What are the pros and cons of a bridge loan? If you are navigating the world of personal finance and mortgages, you might be curious about bridge loans. So, what are the pros and cons of a bridge loan? Let's break it down. A bridge loan is a short-term financing option that can help homeowners or businesses cover immediate funding needs. It is designed to bridge the gap until permanent financing is secured or an existing obligation is paid off. One of the biggest advantages of a bridge loan is the quick access to funds. Unlike traditional mortgage loans, which can take a long time to process, bridge loans can provide fast financing. This speed is especially helpful when you need to purchase a new home before selling your current one. Another benefit is that bridge loans facilitate home purchases during transitions. Homeowners can use the equity in their existing home to make a down payment on a new property. This flexibility allows for smoother transitions without needing to make contingent offers, which can complicate the buying process. Bridge loans are typically structured as short-term loans, lasting a few months. This means there is a clear payoff plan, as borrowers usually pay off the loan when they sell their current home or secure permanent financing. This structure can provide peace of mind during a potentially stressful time. For businesses, bridge loans can help maintain operations. Companies waiting for long-term funding can use these loans to cover payroll, rent, and other expenses. This can prevent disruptions and keep the business running smoothly. However, there are also downsides to consider. One major con is that bridge loans often come with higher interest rates and fees. Since they are short-term loans, lenders charge more to reflect the increased risk. This can make them more expensive than conventional mortgages or home equity lines of credit. Another potential issue is that borrowers may need to make payments on both the bridge loan and their existing mortgage simultaneously. This can strain finances, especially if the sale of the original property takes longer than expected. Additionally, bridge loans typically requiring strong credit and significant equity in the current property. This means they may not be accessible to everyone, limiting options for some borrowers. There is also the risk of the existing home not selling within the loan term. If that happens, borrowers may face financial difficulties repaying the bridge loan. This could lead to foreclosure or other serious consequences. Lastly, while some banks and credit unions offer bridge loans, they are often provided by specialized lenders. This can affect the terms and options available to borrowers. In summary, bridge loans can be a useful short-term financing tool for homeowners and businesses. They help manage timing gaps between transactions or funding. However, the higher costs and risks requiring careful consideration. Understanding both the pros and cons of bridge loans is essential for making informed financial decisions.